Hello and welcome to Trading with Technical Indicators. My name is James Boyd. We welcome you here. Hopefully you had a good weekend and your team won this weekend. Mine did not. Let's not start there. We're not going to. Now, just real quick as we get started, we also have Lee Bull in the chat. We welcome him. We also have Grace, Wiley, Life in the Fast Lane, LJ, Mark, Robert, Oda, and many others. Welcome to all. Now, as we talk about this topic, trading with indicators, remember we're going to talk about this from an educational point of view. They are examples, okay? Also remember that the information here is for general information purpose, not considered an individualized recommendation or endorsement of any particular strategy, chart pattern, or investment strategy. So I'm going to show you some things as examples, and I've said that over and over again. I need you to take it as that, right? And so the biggest thing is, as we talk about these indicators, you get to decide if it's something you would consider. Also remember that we will use the paper money software application for educational purposes. And also remember that when we talk about investing, all investing involves risk, including loss of principal. Now, today, our normal agenda items that we talk about is we're going to talk about the principles of technical analysis. What part of the number? I'd like to talk about divergences. Bullish divergence, bearish divergence. We're going to talk about both, okay? We're also going to talk about some examples from those divergences as well. And I hope that you don't mind here today that we talk about a couple of examples that we could use as maybe things we might consider putting in the paper money account as examples. Now, we also reset the accounts last week, so we're kind of in that idea of kind of building the portfolio, needing examples. Hence, that's why we need some. The second thing we're going to talk about is entries on the whole moving averages and potential exits on the whole moving averages. And I think that exit part is going to be very important when we see a couple charts. So first off, let's go ahead here and let's just take a look at. So one of the things I want to when I wake up in the morning, okay, I always ask myself, what trend is the market in? Is it 1, 2, 3, 4, 5, right? And so one way we could kind of guess what the trend was is we could go look at the VIX. Now, if you looked at the VIX, now LJ, this is for you. I'm gonna give you a big fat softball, and I'm gonna throw it over home plate. If you saw the VIX at like 1245-ish, maybe, well, it was down at a fresh new low just here on Friday. What trend do you think the market would be in? Now, when I say the market, we're talking about the S&P 500. Well, typically, if we see VIX this low, it's a pretty good indication that the SPX is probably in what we call trend number 4, price above both moving averages, but could be up above could be up near an area of resistance. Now, we got to think about that a little bit, right? Because if the prices are above both moving averages, and the prices are up near, let's say, resistance areas, what do investors tend to do? Okay. Now, what I want to do, as we're talking about divergences, is we don't have anything on this chart showing any divergence. We have price only. So what we're going to do is we're going to go right up to click on Edit Studies. And so we're going to go to where it says, we're going to type in MACD for the MACD. And again, the MACD, if you said, I don't have any clue what that is really telling me, don't worry, click on the little question mark. If we click on the question mark, it tells us it's an oscillator study that really is looking at momentum, okay? Where does the price close? Where does the price close in relationship to the highs and or lows? So I think of it as a momentum indicator, okay? Now, if we, and it stands for moving average, convergence, divergence. Now, what I'm going to do is, when we talk about the MACD, there's 3 settings, okay? The 6-13-9, think short-term. If you're a short-term trader, you're probably going to use that setting. If you're kind of more short-term to intermediate, 8-17-9. And if you're long-term, okay, months, you're looking at that trend, you're probably going to use 12-26-9. Now, for our example, we're going to kind of use the middle of the road. Now, why are we going to do that? Well, because I'm going to kind of bet that we're going to be kind of on average, probably right in that sweet spot. So that's all we did is just quickly change that, click on the gear, 8-17-9. Now, what I'm going to do is I'm going to go back down to the very bottom, click on OK, apply, and then OK. Now, One of the things we were just talking about is looking at a divergence, okay? When does the market tend to have a risk of maybe consolidating and or pulling back? Well, if you look at the VIX, what you're going to notice is we have a low right there, okay? You got like another low right there. And then what you're going to see is if we look up kind of down below, okay, when the price was at a low, there's the MACD. When the price made a fresh new low, the MACD was not as low, okay? And as we made another low, we actually see that the MACD is, well, it's not down as far as it was before. Okay, so what's the concern? Is there a concern? Should we be concerned? The biggest thing is when we see the price go one direction, but the oscillator going the opposite direction, there becomes increased risk of buying stocks thinking that in the short term they could just keep going up. There becomes an increasing likelihood that things could consolidate and or pull back. Okay? Now, if you don't believe me on that, don't. But I would like you as homework assignment number one is go back and look at different times where we saw that where the MACD was turning one direction and the price is going the opposite. I think what you're going to find, okay, is that when we have a bullish divergence, okay, on the MACD, that's usually a kind of an indicator to be semi-cautious, thinking probably mentality-wise in the short term, days to weeks, maybe a little consolidation. Consolidation doesn't mean bearish, okay? But we're probably thinking of maybe creating more of a range in the market and hopefully not a deep pullback, okay? We don't know, okay, on that. But we're thinking kind of a little bit more consolidation. Now, super quick. So when we talk about, let's say, divergence, we saw divergence really starting to form on the VIX. I'll also kind of mention what could be a potential trade idea. And I'm going to say it again, potential. Example. I've said example 5 times already, and it's only been 7 minutes, okay? Now, if we take a look at, if we saw that, some investors might think, well, maybe could I put a hedge on in the market? The market being our example given, maybe S&P 500, okay? That could be a product that tracks the S&P 500. It might be for some investors, maybe putting on covered calls on their individual stock positions if they had 100 shares. It might be for some investors, maybe adjusting stops, exiting. It could be even things like, hey, I want to maybe use the future to short, okay? So it could be a number of things there from that. Now, let's also keep an eye on another area where we're starting to see a divergence as well. So what you're now going to notice on the chart is we see there's the low, okay, or a recent low. And what you're going to notice is we made another low, okay? We see there we are. We made another low, and what you're going to see is, well, MACD is getting thinner and thinner. Price going one direction and the oscillator going the opposite direction. What is this? Well, this is TNX. This is a 10-year rate, okay? The TYX, the 30-year rate, is showing the same thing, okay? What might be a potential trade example idea in paper money? Huh? Well, if you followed our futures class, you know that there's one ticker that some investors might consider. Now, we also might kind of think of this as if the rates go higher, where does the stock market tend to go? Well, if you were around last year, you know that when rates went up higher, many stocks found it tough to go up in the face of rising rates, especially when they're quick. So we're kind of seeing this theme of bullish divergence on the VIX. We're seeing it also on interest rates. Now, I'm not going to take you there, but you might want to keep an eye on gold as a potential example. Keep an eye on silver, etc., as well. Okay, but probably more potentially gold. Now, let's kind of also talk about the bearish side of it. Okay, we're talking about a bullish divergence where the price goes down and the oscillator is coming up. Okay, but what about a bearish divergence? What is that? Well, let's bring up the good old NDX. Okay, now if you look at the NDX, what you're going to notice is here's the NASDAQ. Now, by the way, let's give some proper credit. Okay, we saw on Thursday, a brand new high. Well done. Okay, well done. You got to admit that's pretty special, considering what this year, this last year, what it's really been. It's been interesting, but the Nasdaq's still able to crank that out. Pretty impressive. Now, if we take a look at this, we see if we zoom in, this is kind of like the opposite. The price is going up higher and higher, but the oscillator, the MACD, is not getting as high. Okay. Now, what does this potentially mean? Now, I want you to imagine that you came out to Utah and I took you to the south side of Utah, or I took you kind of at the mouth of the canyon, and I said, congratulations, here's your bike. I'm going to pick you up 5 miles up in the canyon or up on top of the mountain, and you might get on that bike and you might charge that hill or mountain. But all of a sudden, about a half mile into it, you're huffing and puffing, like most people. Okay. And all of a sudden, as you go higher and higher and higher and higher and higher, the momentum of that push becomes weaker and weaker. Well, all of a sudden, about mile 3 or 4 in, you're thinking, how far is he? He said he was going to be 5 miles up the hill. I'm not sure if I'm going to make it. And so all of a sudden, the risk of falling back down, consolidating, becomes extremely high. Now, we've talked about a bullish divergence and a bearish divergence. On the NASDAQ, we're kind of seeing more of that bearish divergence on the NASDAQ. And this is where we're going to start to really go into using the moving averages for entry and exit, okay? So when we talk about a bearish divergence, I'm going to give you some tickers because I want to get into example trades. But number 1 is NASDAQ. Number 2, we might also include on this, let me just show this one, is Boeing, okay? Boeing has shot to the upside. Is it starting to kind of peak out in that oscillator, MACD, starting to rotate down? Is Micron doing that? Is QCOM doing that? Is Meta doing that? When I pulled up those charts, that MACD was starting to show divergences as the price was going up, okay? Now, what does this really matter? Well, it matters because if we're talking about I want to use indicators for entries and exits. Well, when we now bring on the moving averages, okay? So, by the way, let me kind of show you something just real quick. And let me go ahead and grab this for just a second, if I could pull that up. Now, some of you might not know previous classes that we did, okay? And I want to kind of just make sure that you know we've been here, but we're going to kind of get a little bit more detailed on it, okay? So if you don't know, this is our YouTube page, okay? And what you're going to notice is it's called Trader Talk Webcast from Schwab Coaching. And what you're going to see is if we go to really this playlist, I want to show you a class that we did from 3 weeks ago, but we're going to zoom in on it now, okay? So home, video, live, playlist. The playlists are really the classes. And what you're going to notice is they're stacked like cards. And if we go down, you're going to see that it will say trading with technical indicators. So if I went down to here, that's this class. We're going to click on it. Now, what this does is it really pulls up something like, it pulls up the playlist from that class, okay? 3 weeks ago, we did a class on differences in moving averages, okay? We're going to talk about this. Understanding what creates potential bullish setups. Last class, starting over and creating focus, okay? Now, if you say, I do not have that playlist, make sure that you bookmark that by just clicking the little star there. That way you can just always pull it up at your leisure. Now, what I want to now do is I want to pull up an example. And what I want to do is I want to kind of bring on the moving averages, just like we talked about 3 weeks ago. Now, the moving averages, now, again, you have your own experience. So do I. I'm entitled to mine. You're entitled to yours, right? So the moving averages, you got simple moving averages, exponential moving averages, whole moving averages, right? The ones that we're going to use in class are the whole moving averages, which is the weighted moving averages. And we talked about that 3 weeks ago. But let's talk about it from a trading standpoint now. Not educational, just here's what it is, but how do you trade it? You okay with that? All right, here we go. Now, As we do this, I'm going to go to the test tube again, click on Edit Studies. Now, I'm doing it like this because I want to imagine that you guys don't have, and gals, don't have the moving averages on your chart. So how do we put them on? We're going to type in whole moving average, okay? Just type in whole, and it's right there. If you don't know what it is or didn't see that class from 3 weeks ago, click on the question mark, it'll tell you about it. If we're going to click on, we can click on that, and what it does is it puts the whole moving average right there. I'm going to click on it one more time, and it's going to put another one. Just like we talked about 3 weeks ago, we're going to go over here to the right-hand side, click on that gear, and if we click on the gear, guess what we're going to do? Well, we're going to change that first moving average to 10, okay? The length, if you don't know what that is, click on the question mark. I'm going to go back to what we did is we're going to go to Style. I call it the highway strip. Width, I'm going to change it to 3, just make it a little easier to see. And when we think about, let's say, I don't know, down, I think most of us think red, okay? Okay, as close as we can get to red just on the simple drop down. We're going to see up, we're just going to flip it to green. Okay, so nothing extremely tough there. Click on OK. Same thing with the 20. 20, we don't need to change the moving average. Length, it's there. I'll just flip it to the highway strip again. Change the width, just like we did before, and just change the down to red, up to green. Okay, I don't think it's too pressing there, and that's just doing the same thing on both. So now when we pull this up, and we now say apply, okay, and okay, you're now going to see that we have these moving average lines. Now let's kind of talk about this for a second, okay? The second part of this learning lesson, so we're going to talk about the divergences and how it relates to the whole moving averages in terms of potential examples. You like that today? Examples? You like that? Okay. We're going to talk about potential examples of entries and exits. Now, I'm going to kind of show you something that's a little interesting. I'm going to start with a stock. And the one I'm going to really start with is example given. We're going to pull up HD, Home Depot, okay? Now, what I'm going to do is as we pull this up, I'm just going to zoom in on this most recent chart, okay? Now, you will notice that there is a slight difference in the timing. When things are going bad, there's that red color on the moving averages. Boo! And then all of a sudden, if we start to get a turn to the upside, we start to see the green line on the shorter term moving average. It's more sensitive, okay? And then what you're going to notice is it crosses 2, and then what you're going to see is 3. We actually see the lagging moving average, the 20, also really goes green. Now, so what you're going to notice is what tends to happen. 10-day moving average goes green, moving average cross, and last but not least, the 20-period moving average goes green. Some people kind of use this as a 1, 2, 3 method. Some investors that are more aggressive, they might get in here. An investor that wants more confirmation, they might say, I want to get in there. And if you said, James, I am more in the middle, they might say, I'm going to get in on the moving average cross. Okay. Now, if there is an update that is large, can you get all 3 of those days in one day? The answer is yes. Just has to be a large candle. Now, what you're going to now notice on this chart is we see that the chart goes up, 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 but then the shorter term moving average goes down. And I want you to notice as the shorter term moving average goes down, the 20-period moving average stays green. Now, what type of price pattern would do that? Where in the short term price consolidates or drops, and then the lagging moving average stays positive. What type of bullish price pattern do you actually have in that situation? That's like bull flag material right there, right? Now, I want you to notice again, we see that the shorter term moving average goes green again. On the date of the 13th, we get a moving average crossover. Guess what just happened? Shorter term moving average goes green again while that 20-period moving average is still green. So I want you to kind of notice something here, and I'm doing this on purpose. If you see that the short-term moving average dips, but the 20 doesn't actually go red, that is bull flag potential examples. Okay? So what you're now going to notice is, you see it again. So the shorter the pullback in duration, days, the shallower the pullback is in percentage drop from the high, the stronger that the trend is. Okay? Does that guarantee that the stock's going to go up? We never say those words guarantee. Okay? We're talking about stocks here, for crying out loud. Now, what I'm going to do in this first example is we're going to buy the shares of the stock. Okay? This class is going to be more stock-based. Okay? And what I'm going to do is I'm going to go buy custom with OCO bracket. So if we talked about, hey, what is someone using as an indicator? Well, we're going to use the whole moving averages as the indicator. Now, James, kind of wrap this back to what we talked about with the oscillator, the MACD. Is it really diverging? I can't say it's really diverging as much as the NASDAQ is. The NASDAQ, we saw just kind of dripping down over time. Here we see that the oscillator, the MACD, is about as high as it was before, and so far staying above this zero line. Now, one of the traps about a bull flag, especially a short-term bull flag, is that you're always thinking the pullback needs to be longer. Who said that? Nobody said that. That's how just the investor feels, right? I want a deeper pullback. Well, you get a deeper pullback. And then does the investor buy? Well, maybe not. So sometimes people just say stuff. So if we're looking for an indicator to get in, the investor might say, I'm looking for both lines green. Okay? If both lines are green and we're showing maybe a breakout, close above the high low day, etc., not diverging, that's a setup for an example. Now, what I'm going to do is I'm going to right click on the chart, buy custom, and I'm going to now go down to where it says with OCO bracket. Now, what we can also do is we're going to use this most recent pullback area. Like where? Let's show you where. If I said, well, where could we do this? We might kind of say, James, we're going to set a line maybe right about 303-ish. And we're going to set a stop right below there, 302, 303.52. Okay? Less 2 to 3%. If I did 2%, it's 0.98, which is 2% less than 303.52. If I said, okay, give me, what's that number? 297.44. 297.44. Okay? Now, what we're going to also do with this is we talked about capital size. We're going to do this in the IRA. When we look at the IRA again for just a second, I know that, let's move that off. So when we look at the IRA, capital that we have is $185,000. Now, you could do what you want, but we teach position sizing. So we try to identify, is there a certain amount of capital that the investor will be willing to put in? Let's say we're going to use 5% capital. Okay. Well, what's 5% of 185,000? Well, 5% of 185,000, okay, is going to be 92.50. What are we going to do with that? Well, so now what you're going to notice is I'm going to click on the pool balls, percent, dollar amount. This is, think of this as the budget, okay? If we do this 92.50, that's the amount of capital that we're going to allocate to the Home Depot trade, okay? What we're now going to do is right above the dollar, we're going to click on that little icon, and it's now going to tell us 29 shares. Now, what we're missing is the stop to GTC. What we're missing is also the target. So this is where I need your help. Where would you set the target? Now, if you like to play flags, you might measure the pull. Okay, number one. Number two, you might say, well, instead of measuring the pull, I'm just going to go back and look on the chart and ask myself, is there any areas of previous resistance on this chart? So C Bravo, Speak Truth, okay? Wiley, Don, Lisa, is there an area? Now, when I say resistance, it could also be an old support area. On this chart that I'm showing you, was there any prior support before it fell down. Well, when we say it like that, we might say, well, James, this was an area of support. When we fell down through there, that 323 was kind of a sensitive area, and things kind of just hit the skids. Okay. Now, we're going to put that 323. Matter of fact, we're going to put 322. Okay. Right there. Now, why the 322? Why not 323? Well, some investors would like to maybe sell a little early, then stay too long. Okay. So we know that the resistance support is an area. Okay. So what I'm going to do is going to put 322. Got to stop at 297. Now, again, this is different than most people, right? Where they say, well, your reward risk ratio is, not this or this. We talked about that last week. Okay. And also you can set tighter stops, but all you do is you go down the path where you have a high chance of getting stomped out. Okay. Now, the biggest thing is if we go to confirm and send, notice it says this order is based upon a dollar amount. We specified that we're going to use 5% of the capital as an example. That's 12. I'm counting today, okay? Just personal. I'm just counting. Now, what we're also doing is a stop. And what is that doing? Well, there's no guarantee the execution price will be equal to or near the activation price. So if that stock gaps down, it's going to try to fill as soon as it can, but it's not saying that it's going to sell right at that price. It's a market order. Okay, now if you were so concerned about selling an exact price that you'd probably look to do a different type of strategy. And we do that on Wednesday called protective strategies. We're going to send the order. Okay, I'll fix that. Now, the biggest thing is I want to go down to another example. So this was an example of really using the moving averages in context with the MACD as well. Now, the other one I kind of want to bring up is I want to kind of go back to the example of Amazon, okay? Now, if you look at Amazon, and I want to kind of show you this a little different. If we look at Amazon, what you're going to notice is we fell down, and we actually saw the price go down below the last low, and on earnings, it gapped back above, okay? Now, let's count them together. Now, I just need you to count to 3, okay? So if we said, okay, what's 1? 1 is when the 10-day moving average goes green. Check, 1. 2, we actually see that the moving average crosses over. Wait, but on that day, on that big pop on the price, it gaps up and it shoots higher. You're going to see that number 2 and 3 are on the same day. And that can happen if there's a big move in the stock. Now, what you're going to notice is I want you to pay attention to what happens here. What do you notice as far as the shorter term moving average in this area? What do you notice right here? The shorter term moving average crosses down, but it doesn't do what? It doesn't do what? That moving average, it doesn't turn red. Would that be a bullish potential signal indicator? Or would it, for example, be a bearish indicator if you can't get the short-term moving average to go red? Well, you might say, well, James, if I saw that, that would be typically viewed as a bullish setup. Okay. Now, some of you are asking in the chat, well, how would you find those? I'll show you those. Just be very patient and I'll show it to you. Okay. So if we get that moving average crossover, but that short-term moving average doesn't go green, that might be viewed by some investors to be a bullish potential setup. Now, if we did see one of those moving averages go red for just a day, only to see the moving averages go green again, and the moving average to cross or pinch, would that be viewed as a bullish indicator? Bullish setup, example, number 13, would it or would it not? How would you read that? Well, many investors might say, James, I kind of see that as a bullish setup. Now, what we need to understand is we can't see past today. Every entry has risk to it. Every entry has risk. So that's why the position sizing is really important. So if we said, hey, you know what? I want to actually right-click on this chart. We're going to do an example. Are you counting for me? We're going to now go down to buy custom. We're going to do with OCO bracket. Okay. Now, what I'm going to do is once I go with OCO bracket, you're now going to see is we're going to go back to the pool balls. Now, this is what some people call boring. What do you mean by that? Well, I don't know if you've ever done this, but some people say when they find a stock they really like, or they saw someone on TV that was talking about something and they really get emotionally involved, and they say, this one I think is going to do good, and I'm going to overweight it pretty aggressively. By the way, you could do that, but we're not going to do that. Any position, okay? Now, by the way, the big money account wouldn't buy any of them unless it thought it was going to go up. But the problem is we still don't know which one is going to go up. Okay, we don't know. So what we're going to do is we're going to treat them all the same in terms of capital, pool ball, percent, dollar amount. We're going to go back to that 92.50. Okay. Now what we're going to do in this case is the price. We're going to have to change that to what is the price now? 148.90. Okay. Where do you see the plateau of support? Well, the plateau of support. Okay. I kind of not. Eric, where do you see it? Tom, where do you see it? David, where do you see it? JC, talk to me, buddy. Where do you see it? If I said, now when I say plateau support, when you talk about setting stops, we're talking about setting stops in the last maybe 1, 2, 3 weeks. So if I got a ruler out or a level, and I'd say, well, if I got a level out, I'd probably say that level was probably right about this area, about 140-ish or so. Okay? Now, so if I brought back up the calculator and said, okay, we got about what? 140, 47, less 2%. Okay. So it's going to be right around there. Let's say 137.66. Now, I'm going to kind of tell you something that we've talked about for a long time. And I'm just going to, I didn't plan on doing this, but I think it would be helpful if we did. Okay. And the reason why I want to kind of do this is there's a lot of people that are just uncomfortable in taking risk. Okay, fair. And I kind of want to put it mathematically, and I think when we put the math to it, I think you'll become a little bit more comfortable. So if we said the entry was 148.96, if I said that the support was 140.47, and if we said the stop, as we stated on that chart, 137.66, okay? So we're looking at the potential risk. And that potential risk would just be from the entry down to the stop. Now, why did you use the word potential? Because the stop is a market order, okay? That's if we got stopped out there, the risk would be the 11.30 per share. Now, we like to kind of express this in a percent. So what we're going to do is we're going to kind of look at the percentage risk of entry. And so if we did say, if we took $11.30 of risk and that entry was 148.96, the percentage comes back to 7.58%. What do I do with the percentage? Well, if we got in, for example, if we were risking 3 to 5% of the entry price, what does that mean? That means that we are close to support, okay? That means there's probably a fresh, can you smell that? Smell it? There's a fresh new setup example. You counting? We're at 15 so far, okay? So here's the deal. And I'll come play with this math in just a sec. There's a fresh new, and what would be the entry example? Hold, a moving average crossover, horizontal breakout, blah, blah, blah. Okay, all the above. Okay. Now, if I looked at this, if we said, hey, we're about, let's say 5 to maybe, I'm going to say 5 to 7%. I'm going to say we're a little elevated. Okay. Off support, elevated off support. I'm going to say the entry was probably, it's past 3 days. Okay. The moving average cross was probably 3 days old. Okay. The hold was probably 3 days old. The breakout was probably 3 days old. And if we're probably in this example, 7%, we're kind of at that, let's just use the word elevated. Okay. Elevated. And if we're 8% plus, we might ask ourselves, is there a better time to enter? We might even consider something like a limit order closer to support. Now, why do you care? Well, the thing is, if you get in farther off the support area, you're risking more. So let me just kind of have a come to James session. Everyone gather up. Everyone talks about indicators. But I think what we really need to talk about is the person using the indicators and how much trust and do you understand what's causing those? And could you systematically trade those? Because you can have all the indicators you want. It's do you actually use them? And how good is your timing? Now, with that said, let's go back to something. So if we were to get into this, let's say at 145, what happens with the percent? 5%. What does that probably mean? We're elevated off support, but we're just probably closer. We're taking less potential risk. If we got in, let's say 144, we're at 4.4. What does that tell us? It's probably closer, okay, to the support, the hold, the moving average breakout, crossover, the breakout was probably in the last 3 days, and it hasn't exploded to the upside yet. And we're wondering if it could in this example, 16. Okay. Now, if we take a look at this, Greg's question is, I am confused as whether to use a 10 EMA, 30 SMA, or a 10-30 as in the previous classes. Okay. Now, so in our example, we've used two setups. James, why do you use two setups? I use two setups because I was told not to use one. Just being honest. Okay. So if we look at, let's say, the 10 EMA and the 30-day SMA, remember, that's going to lag, right? If we used a 10-day whole moving average and we did the 20, and why did we do the 20? We said this last week. The 20-day whole moving average. Why did we use the 20? We had choppy market conditions. And if you're in choppy market conditions, if you use a lagging moving average, by the time you get an entry, you're 3/4 in the way of that expected move or channel, and it's going to cause you to be late to get in, late to get out. Is that a great setup? Maybe not. So let's say we were in trending market conditions. Could we actually go back to the 10-day whole moving average or the 30? Yeah, but we need the market to trend stronger, right? So now if we look at a 10-day EMA to a 30-day SMA, and we compare that to, let's say, a 10-day whole, 30-day whole, which one is going to be more sensitive? So, Greg, if you ask yourself, are you more of a trader? If you're more of a trader, you're probably going to use a moving average that's more sensitive, like the whole. If you said, James, I'm not really a trader, I would say I'm more of a trader to an investor. Well, you probably use the 10-day EMA and the 30 SMA. Okay. I think it's also important to understand market conditions, though. Okay. If the market conditions are a little choppier, you might switch the moving averages you're using because you're understanding what the market is giving. If the market's chopping back and forth in a range, using longer duration moving averages, slower moving averages, like simple moving averages, I don't think it's going to be as helpful. Okay. So I think that's where it kind of comes down to is having two settings and understanding when would you use one versus the other. Okay. That's what I'd say there. All right. Now, I want to kind of go back to something. One of the things we actually brought out, let's kind of put this target here first, and let's kind of talk about how would we find examples of like these charts that were showing both whole moving averages green or one down, but the other one positive. Let's pull it up. Now, I'm going to change this limit to, let's say, GTC. We're going to go dated GTC, okay? Now, what we're going to do in this case is we're going to set a target. Where's the target? Well, we're going to go back on this chart, and we're going to click on the little minus. Now, we can go back to, now this class is not on price patterns, but my gosh, if we're talking about technical analysis, we might measure what some technicians might call the cup. Well, the bottom, okay, 124, 144. some technicians in this example, 16, or am I at 17? I forgot. Okay, we're up there. So what you're now going to notice is that's 20 points from the base to resistance. Now, that's just a forecast. It's what it sounds like. It's a forecast. It's not actual. That's why you use the word actual. So now what we're going to do is we're going to put a target at 164. So let's go back to the chart or the trade ticket. We're going to put 164 here. Now, once we put 164, limit. That is saying do not sell that unless the stock goes to 164 or higher. If it goes to 164 or higher, sell, 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 sell. In this example, in paper money. Then if that stock were to go down and not go to the target, if it goes to 137.66 or lower, sell the stock. And you sure hope that it sells as close as it can to the 137.66. Okay. Now, what we're going to do in this example, we're going to take the same capital size that we talked about last Monday, 92.50. There's the shares. I'm going to confirm and send. And now let's read those orders in red. Okay. We know that the position size is based upon a dollar amount. We talked about that. Stop orders, there's no guarantee. The execution price, what it fills at, is equal to the activation price, which is the stop in this example. Okay, good. Now, what I'm going to do is let's kind of now talk about, but how would you find these? I mean, do you have to go through one by one by one? I work a full-time job. Okay, well, let's kind of talk about this. No need to get all testy, okay? So let me kind of do this. This is what the market watch is really for, right? Now, when we go to the market watch, what you're going to notice is, and we talked about this last week, and this is why we brought up the playlist from last week. So if you said, I didn't see what you talked about last week, well, not yet. Cancel what you're doing past 5 o'clock and tell someone, turn off all those other things you watch and watch what we talked about last week. Now, what I'm going to do is we're going to go right back to this. And one thing we can do is we can customize these headings. Guess what we're going to want to put here? We're going to right click on that, customize, and I'm going to type in here whole. Okay. And if I type in there whole, what you're now going to notice is the 10 whole. Now, I have put this on my side. I'm going to try to send this to you. There's the 10 whole, and there's the 20 whole. Now, listen when I say this. You cannot pull up the Russell 2000, and it's not going to screen it. It will typically screen a list of 50 stocks or less. Okay? Now, what I'm going to do, just for simplicity, is I'm going to take off some of the things we looked at last week. Okay? Sad when I do that, but let's say we do it. And I'm going to look at this right there, the 10 hole and the 20 hole. I'm going to say, okay, now what we're going to see. So I am on the Dow Jones list, market watch, quotes, right below quotes, right below it. Click on it. And then go down to public. Now, here's what I love. I love kind of finding things that are interesting and then using them over and over and over. I just love that, okay? So we're going to pull up the Dow Jones. And now what you're now going to notice is we get a column here, the 10 hole. Scripts are not guaranteed for accuracy. Verify, okay? Now, what we're going to do is the green in the background means the moving average should be green. Verify. Script's not guaranteed for accuracy. Now, if we go down, what you're also going to notice in this is it will also have, it gives us a counter. How many days has that moving average been green? Been green for 23 days. Okay. Now, what you're going to notice is this one tells us right there that's been green for about 7 days. Okay. 7 days, 8 days, 8 days. Now, I know on my side, from you're seeing on my screen on yours, might be harder to see that. But what you're now going to notice is what's the red? The moving average line is red, should be. Script's not guaranteed for accuracy. It also states how many days has it been down. But how do I find something where the short-term moving average is down, but that lagging moving average is still green? Let's think about it. Let's put our heads together. Well, what the investor might be thinking is, geez, this one right here, Intel, that has a short-term moving average down. The moving average on that 20-period moving average, doink, is still green. So if I pulled up Intel and said, what do we have here, Mr. Intel? We pull up Intel, and what does it look like? Oh, maybe what some investors are looking for as an indicator for a potential bull flag. What do we mean by that? Well, because remember when we started with our second agenda item, we talked about stocks that ran up in the short term, that in that short term, maybe just days, the shorter term moving average was red. Okay? And if that short-term moving average is just red for 1 day, 2 day, 3 day, 4 day, but that 20-period moving average is still green, that would be probably a pretty high candidate for a potential flag setup example. I don't even know which one I'm at. 18, 19. Okay. And then if you look at right now, you're now going to see that right here, there it is again. 1 day, 2 day, etc. So let's kind of go back and let's kind of bring this together. So what you're now going to notice is if you say, hey, James, how could I get that? So on my X page, we have these. And when I say X, that's also formerly known as Twitter. Okay. Now I'm going to send this script to you that is of the 10 hole. On the 20 hole, I'm also going to send this to you and share it with you. Now, I've been working with a couple of you that said, hey, I had some issues or whatever. But what you're going to notice is many of you are getting that. And this is a nice way to scan a list. Now, the last thing I want to say is if you said, James, is there any way that I could change the font? Well, I should say the color so I could see it better on my side. Sure. Another way you could actually do it is click on the gear, application settings. And if you said, I want to go to look and feel, and I don't want to do dark, I want to maybe do like, let's go light, okay? Apply, and that can even help, okay? So there you go. Go to the setup gear, or gear, application settings, and now what you're going to see is look and feel. And if we go to look and feel, we just went to light. Hopefully what you see by this is, man, the Thinkorswim tools are pretty amazing. I wish I had this stuff when I first got started. We didn't have anything like this. It was as a fax machine and printers, and there were DOS printers, stuff like that. It was just slow. This stuff is amazing, okay? The tools, if you have an idea, there's a pretty good chance you could potentially do it. I want you to go out and practice the whole moving averages. I want you to look for bullish and bearish divergences, okay? We did 2 new trade examples here today. John McNichol, he was out of the country, he is now back. Starting next week, he will actually be teaching this class as I was filling in for him. A quick homework assignment, I want to make sure that you go review the past 4 lessons that will include today. Make sure you're up on those. This really gives us a foundation of what an investor might consider and why. I'm out of my time here today, but with that said, thank you so much for your comments and your participation. And also thank you, Lee, for answering those questions in chat. With what we discussed, it was done for example, illustrative purposes only, as an example. And with also that, remember that all investing involves risk, and this has been the class on trading with technical indicators. And with that said, thank you so much, and stay tuned for our webcast coming up right at the top of the hour on Trader Talks with Schwab Coaching. Bye-bye.